Tonight, we're going to be talking a little bit about how to use option strategies in today's markets. Again, my name is Don Kaufman. I want to welcome everybody. We are, as I said, going to go through quite a bit this evening. Right up front, let everybody know we are not financial advisors or a broker-dealer. I spent the previous portion of my career in the brokerage industry. Hence, while I throw that up there, I'm no longer a broker-dealer. We do not transact any securities here. Also, a copyright disclaimer. This is ours. This is not yours. But that's okay because we will give you the recording of it. All right. That's a picture of me. Yeah, I think I've got to update this. A little bit less hair. It's more gray. You know, I blame 3 children. Anyway, again, my name is Don Kaufman. I'm the co-founder here of TheoTrade. I have been around this business now. In fact, this happens to be none other than my 20th year trading. I started trading in the late 90s, right outside of school. So I, again, spent 4 years in school, right outside of school. I was invited to trade in Chicago. Just about 2 years after I started trading in Chicago, I was invited into what was at the time a no-name, a small startup firm, and that firm happened to progress into what was known as thinkorswim. I was at thinkorswim roughly from 2000 all the way until roughly 2015. So it's a little bit of background on me. I've got 17 years of thinkorswim platform experience. I was at thinkorswim through the time we initially went public, through the acquisition by TD Ameritrade. I went on to actually run TD Ameritrade's education for their 7 million clientele ultimately for 5 years before I finally retired out of TD Ameritrade. And ultimately we launched TheoTrade. I've also done a couple of CNBC appearances over the years. This one just happens to be my favorite. Again, I mean, listen, if you're going to be pitted against somebody, this is the guy you want to be pitted against, the Beast. Actually, he's really not such a bad guy at all. I know everybody calls him Mr. Wonderful. He's actually an extraordinarily nice individual and had the chance to talk subsequently, not just on CNBC, but a few shows over the years. Nevertheless, doing the CNBC tour has always been interesting over the years. About TheoTrade. So, you're tuning in tonight. You have no idea what a TheoTrade even is. Well, as I said, I ran the education for both thinkorswim and TD Ameritrade for many, many years. And it got to the point whereby working at a brokerage firm, the constraints of being a registered representative. And if anybody's ever been in the financial industry, you would know this. By the time Dodd-Frank rolled around and, really when it was really instituted in 2011 and 2012, it was impossible to do anything. So that is in fact, the primary reason, if you wanted to point fingers, hey, why did Don eventually leave, thinkorswim and TD Ameritrade? There was actually wonderful, time there. Nevertheless, the regulations just cranked down so tight, you couldn't even talk about trading anymore. So, hence, we launched TheoTrade. And TheoTrade specializes in education for stocks, options, futures over here. We're founded by professional traders and trading educators. Everybody on our crew here has a minimum of 15 years of experience. A couple of them have as much as 4 decades, which I'll show you here momentarily. And what we're really designed to do, number one, we're here to help you mitigate risks. I know everybody's like, I want to make money, I want to make money, I want to make money. Yeah, but if you lose it, what good is, the discussion? We got to mitigate risks first and learn a skill set that's going to last you a lifetime. Your TheoTrade instructors. TheoTrade, it's not, we don't just have one instructor that comes out of the blue over here. We have an entire team. Many of us do research, work together and kind of cohesively. You may or may not know some of these names. Doc Severson. So Doc has been around for a number of years in this industry, stocks, options, and technicals. Corey Rosenblum, swing trader and technical strategist. That's one of our most recent individuals to join the TheoTrade crew. Then we come to Jeffrey Bierman. We call him the professor. Well, because he's a professor. He's a professor for DePaul in Chicago. He's also a stock trader, and Jeff worked side by side with me. He was the chief market technician for TD Ameritrade, which is a highly coveted position given the fact they have 7 million clients. Jeff did the exact same as me, got sick of the regulations, hung it up, and joined us here at TheoTrade. Then we have Steve, better known as Slim Miller, 43-year veteran stock options futures traders. Last but definitely not least, Tony Rago. Tony actually specializes, he's our intraday strategist. He predominantly trades NASDAQ futures. But I always like to introduce people to kind of, the crew, and many of the presentations, including what I'm doing tonight, is kind of a cohesive strategy that we put together, together. With that, what you're going to learn in this presentation this evening, we're going to talk about the right strategy and approach for any market condition. We're going to go through a lot of different strategies. We're going to talk about intraday, swing trader, long-term investor, really using the right time frames, the appropriate risk exposure. We're also going to talk extensively about how small adjustments and tweaks to your current trading regimen can really alter your results drastically for the better. How to understand, first of all, what correct trade logic happens to be, and strategy can mean for the positions in portfolios. So I like to provide a much more systematic approach to markets. All right, how to identify the flaws within your trading strategy and prevent from being, all of these flaws prevent you from being a consistent, trader. Flawed trading strategies, that's a big focus for tonight. We're going to learn then to exploit some mathematical edge when it exists, and really what the right steps are to take, whether you're trading or investing. That's some of the primary focus. Again, we're going to go through a lot tonight. We're going to hit a lot of different strategies, so kind of strap in right now. We're also going to even go into, a lot of presentations you go to. Everybody spends all the time on PowerPoints. I'm going to deviate. I'm actually going to go into a live trading application during portions of this evening. So I'm going to start this evening with just this title over here: Experience is worth the millions. Okay. And what does that mean? So for 15 years, I worked educating and watching order flow for thinkorswim and TD Ameritrade, 7 million clients. Okay. One of the things that people don't really recognize about brokerage firms is, first of all, when we're all thinking about brokerage firms, we're like, they are evil, they are large, they are this, they are that, they're taking advantage of me, and there's all these conspiracy theories. Let me tell you something. A brokerage firm that has millions and millions of clients wants to do what is in your best interest. The bottom line is they just want to keep clients. It's not even so much about commissions. Do you realize that some of the bigger brokerage firms today have over $1 trillion in assets? The other aspect, and the reason that I bring this up, is because those 7 million clients, the brokerage firms learn from their clientele. And that was one of my primary positions. I ran education. We looked at hundreds of thousands of accounts. We studied them in every way, shape, or form. We looked at people that just traded stocks and just traded options, traded stocks, traded options, traded stocks, options, and futures. Some of them that traded currency products. You name it. You name a strategy. I have got some degree of statistics on that. But the bottom line with all of it, when you have the ability to run different types of studies. By the way, when I say, I've looked at 100,000 accounts, it's not like you're opening up an account and go, what is Tom doing today? What is Joe doing today? That's not how it works. Okay. You actually run studies. You have what I call a math geek, and the geek sits down and he runs different studies. But the bottom line is you learn what works and what doesn't. Right? And what doesn't, it just gets repeated over and over again. So tonight, I'm going to start with identifying areas of weakness, followed by how and when we can approach and exploit market opportunities. That's really what I want to start with, is just, hey, listen, this is one of the things that, there's some axe to grind with traders because they just do the same thing again and again. And I'm going to show you one of those right now. So with that, all right. By the way, somebody said there's now 11 million clients at TD Ameritrade. You are correct. In my time, I'm sorry, I only got to see 7 million of them. Let's start with just buying call options. Okay, now I'm starting with already talking about options. So, hey, cat's out of the bag. I said the O word. Yes, we're going to talk a little bit about options. So I'm kind of curious, and listen, some of you guys are going to be watching this on a recording. Some of you are watching it live. How many of you, okay, have options experience? If you're live right now, you can type into the chat over here, yes, I have options experience. If you're watching this in a recording, I don't care. Just start screaming at the screen. I do it all the time. It's very therapeutic for trading. All right. Wow. I mean, almost everybody. I've seen so far 4 people have come through with saying no. All right, cool. So if you've had some options experience, and I'm going to give you this right now, if you had some options experience, you're going to get a lot out of this. If you've had absolutely no options experience, don't get frustrated. What I want you to do is I want you to grasp the big, broad strokes of logic. And you're like, I don't even know what that means. You will. Okay, when I say broad strokes of logic, we're going to kind of separate right from wrong. We're going to separate like what strategies work and what strategies just fail right off the bat. Okay, I'm going to start with something very, very easy, like a call option. And I will explain it as we go along. By the way, I apologize. I will cough from time to time. I hope everybody out there is feeling all right. I had that wonderful flu over 2 weeks ago. I still have the lingering effects of it. So we buy a call option in Apple. All right? Apple goes up. Do we make money? I mean, it's a fair question. So what you're doing out there is we're going to go out and we're going to buy a call. What's a call? It's the right to buy the stock. Okay? Apple goes skyrocketing higher. Do we make money? Well, this is something that you really need to think about. It's your approach to the marketplace. So I'm also going to make this very specific and very, very recent. Okay. And the reason I'm doing this is because, well, I want to be specific and I want to be very reasonable with the example over here. And the example, is this recent enough? Between January 3rd and January 16th. Hey, look at the date. It's January 16th. Today, I'm broadcasting this on January 16th. Granted, you might be watching a recording, but all I wanted to show you is that Apple in that time frame has gone from roughly 172, okay, to about 177 and change. So for the most part, what do we got over here? We got plus $5. So Apple's up about $5 in what? 1, 2, 3, 4, 5, 6, 7, 8, and today is the 9th trading day. Okay. That's all I really wanted to start with. Now, the reason I brought up also one of the most recent examples, if you haven't looked at markets in the last couple of trading sessions, okay, it has been skyrocketing. Everything, all right, buy everything, skyrocketing since the beginning of the year. But the irony of that is, well, let's go out and let's strategize this. Apple, and this happens to be on January 3rd, 2018. This is the exact price that Apple was at. And again, I'm going to kind of highlight this. So Apple was trading at 172.23. Now, one of the common things that's done, now this doesn't mean you're going to do it, but one of the common things that's done is people go out and, for example, they buy cheap options. They buy, for example, the January 19th 180 calls, and the things are only trading for a 34-cent debit. Now, again, this is for people that are brand new. What's a 180 call give you the right to do? Let's just spend a minute and go through some of the basics. And that's what this example is about. If you've got experience, hang in there a minute. Because I'm telling you, we'll go from the basics tonight to the absolute extremes. Okay? So we're going to go out there and we're going to look at a 180 call. 180 call, what does it do? It gives us the right to buy the stock at what? 180. Does the stock have to go to 180 for me to make money? Well, not necessarily, but I do have the right to buy the stock at 180. What do I want? Well, right now, stock's trading 172.23. Well, I want that stock to get, up as close to or exceeding 180. I mean, if the stock goes to like 300, beautiful. Why? Because I have the right to buy the stock at 180. And that's what a 180 call effectively gives you the right to do. Now, I went out, I bought the call. So what else do I need to do? Okay, well, you sit, you wait. You need the stock to go up. Now, again, quick example here. This happens to be now just a few days later, okay? And again, just a little fast forward in here. A few days later, now it's January 16th, right? That's today. And the stock is actually shot to 177. Take a look. And by the way, this was a live shot that I took today. Take a look at the price of the call. So you could sell the January 19th 180 calls for a 34-cent credit. You're like, whoa, 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 whoa. Back up there. What did you just do? Well, I went out, okay, on January 3rd, and I bought an option for 34 cents. Why? It was cheap. I bought the option for, 34 cents. And then I sold it for 34 cents. What did the stock do in that time frame? It went up huge. I mean, it doesn't sound like a lot, but it's Apple. Okay, Apple is an absolute behemoth. It's the largest market cap in the known universe. And the thing rallies by $5. Everybody's like, oh yeah, you're going to knock it out of the park. No, you broke even. And, I was looking at all these different examples, and some examples were great, and some examples were not so great. But the irony is, this is what happens to you. I mean, people go out there, they buy call options every single day. What do? They're like, yeah! It's like setting off, this trade, and it doesn't do anything. It's a complete dud. It's like thump. It just fell completely flat. Now, got a good question. Has anybody ever experienced this before? You bought an option. You did what felt right. I felt right, and nothing ultimately worked. Huh? Come on, people. Is admitting it the first step today? Yes. All right? Being right, it isn't everything. One of the things that I as I said, I want to take ideas that you have. I want to take flaws in your trading. I want to exploit them. The reason you have to exploit them, you have to learn. When in trading, you have to learn that, first of all, being right isn't everything. You were in a trade. You felt you did everything right. Come on, your directional bias, it was correct. Like if you're making a checklist over your directional bias, yeah, I had a MACD, I got my Fibonacci, my Fibber-Bollinger Band. I'm making that up a little bit now, but my Fibonacci was correct. Timing and entry were effective. I mean, that's the point I want to make. If you looked at a chart on Apple from the 3rd to the 16th, right? Those dates, you were spot on. That's actually why I picked those dates. However, you did not make money. It's just totally disheartening. This is why people get hammered trading options. I mean, there's like this stigma around options. First of all, you should always sell them. No, you shouldn't always sell. You shouldn't always do anything. All right? This is like people jumping off of a cliff that become lemmings. But in options, there are effective trades. There are effective ways to take trades. By the way, I love this, the agony of defeat. I had to put that in there. If you guys remember back all the way in the 1980s, the agony of defeat was right around the time of the Olympics. The Olympics are coming. Makes me think of it. In trading, again, being right isn't everything. It's about your approach to the markets. How you approach and effectively trade in markets is often more significant than being right. Now, that's a big statement. I mean, you bought an option. You watched the stock move your intended direction, yet nothing. I mean, what went wrong in this? Now, here is where I want to deviate for the first time into a live trading application. Okay? And if you're not familiar with any trading, it's okay. This trading application, it is thinkorswim. It doesn't matter. All right? By the way, do I trade on this? Yes. But people, I helped put the thing together. Like I was there for, most of my career. When you spend, 15 years somewhere, you're pretty familiar with it. That's it. Like you could trade with whoever you want. Now, here's Apple. And again, I kind of detailed Apple. I felt like, the timing of that trade was just beautiful. You missed the first day of the year, but, the timing is right. But let me show you kind of a little tidbit over here. I'm just going to open up an option. And we're looking right now, again, at an option. I'm just going to pick one 31 days out. And I'll tell you why. I'm picking an option that's 31 days out, only for the reason is it's exactly 1 month, right? And I want to show you what happens to most people that, quote unquote, they effectively buy options. Well, where a lot of people go wrong is, let's say that you think in the next 31 days that Apple's going to go up. Now, Apple even has earnings in the next 31 days. So you think that Apple is going to go up, all right, in the next 31 days. So you're going to go out and you're going to buy, and I want you to keep eyes on this. You're going to buy a 185 call. Now, 185 call gives you the right to buy the stock at 185. You could buy the stock at 185. Now, this is what's going to happen, okay? What you're looking at right here is what they call a theoretical pricing calculator. You're like, I don't know what that is. I mean, because some people here are brand new to options. They're like, I don't know what you're talking about. It's a model. What it does is it models the future. Okay. When I say models the future, you could just change the inputs, right? So what can happen on a day-to-day basis? Well, date, time can move where? Forward. What else? The stock price. Okay. Stock can go up or down. What else? Volatility can change. But you know what? Let's not even worry about volatility. All you got to worry about, I know sometimes that's a little hard to read. Here, let me put it in a different color. All we're going to do is this. We're going to take this little price right there. See that $1.94? That $1.94, okay, is the theoretical price. It's a theoretical pricing calculator. And what it lets us do is it lets us simulate if things are good trades or bad trades or not such a good trade or not such a bad trade. And let me show you one of the major flaws, okay, in people's trading. I'm going to go to this theoretical pricing calculator. I'm just going to push the date forward. You ready? Okay. Here's a calendar. It's Tuesday, January 16th. Welcome to Friday, January 19th. Now, we don't know if the stock is going to go up or down. Let's assume that the stock does nothing. Okay. Now, look at the price of your option. See, your 185 call, it was trading. And again, this stuff is huge. It was trading for $1.94, but now it's worth $1.74. You're like, but what? How'd you lose 20 cents? Okay. You lost 20 cents because of what? Well, the date moved forward. Time is bleeding out of the option. So here's the interesting irony. Okay. The stock has to go up. Let's say the stock starts going up. Okay. So now I'm actually moving the price of the stock. Like I'm literally moving the price of the stock. And between now and just Friday, by the way, this is like 31 days, but between now and Friday, did you know that this stock has to go up? Has to go up. Okay. At least what? Here we go. 77 cents just for you to be able to break even. In fact, you wouldn't even break even because after commissions. Now, I want you to think about that example because no, this is just 3 days from now. What's going to happen a week from now? Oh, no. Now I fast forwarded all the way to January 26th, the week from now. Now the stock has to go up. I don't know. Let's make it like bigly. Does the stock have to go up big? Let's move up the stock $2. Nope, that's not going to do it. I have to move the stock up almost $3. Okay, there you go. Now, think about this for a second. You go out and you bought an option, and you bought the option for $1.94. Between now and January 26th, that stock has to go up $3 just for you to be able to make what? Oh, not even 10 cents. Does that help you? You know, a lot of people look at this, they go, well, that's pretty cool. Okay? This is not about being cool. This is about understanding that do the wrong thing in options, you're going to lose money. Okay? You will lose money. Time moves forward. Okay? The stock doesn't move your way. Like, think about the position that you're putting yourself in. You're putting yourself in a position that, you know, here's Apple, and I'm actually going to write this out for you a little bit because I think it's such an important concept. And again, I said, for the brand new people, just grab the concepts, right? Apple has to move up. Now, what could Apple do over the next week or two? Well, Apple could stay flat, Apple could move down, or it can move up. The only thing, though, that was going to save your behind in that trade, Apple had to move up a minimum of $3 just for you to be able to BE. You know what that means? Break even. That is totally insane. It's completely insane. And that, okay, is one of the things that we'll focus on. One small tweak from huge potential. In the aforementioned Apple example, okay, what could we have done differently from a strategy perspective? All right, just buying the call clearly isn't going to work. Your one small strategy tweak, all right, just one small strategy tweak, and this Apple trade is a potential home run. Let us do it again. Same stock, different strategy. Now, I'm going to use, and again, you may or may not be familiar with the strategy. I am going to use what is termed a spread. Okay? What is a spread? It is the simultaneous, and I apologize right here because I do see a typo. This is supposed to say 175. I'm going to clarify that here, okay, in just a moment. That is a 7 right there. Okay? So this is the simultaneous purchase, all right, of one option and sale of another. Okay, in fact, here is the spread right down below. So let's go into this. It's the exact same type of position, meaning that here's Apple again, and Apple is at 172.23. Here we are back on January 3rd, 2018. That's the trade date. We're just going to buy one option and sell another option. Now, let's get into the specifics, the tactics of this, because what we're effectively doing is we're buying a 172.50 call, buying a 170, okay, 2, and I want to make that clear, 172.50 call. Now, what does the 172.50 call give him the right to do? It gives him the right to buy the stock at 172.50. We are simultaneously selling, okay, a 175 call. Now, we're a buyer here. We're a seller here. Now, some of you, maybe you've never done this before. Maybe you don't realize you could sell something that you never even owned. Now, we're buying a 172.50 call. I have the right to buy the stock at 172.50, but I'm obligating myself to give somebody else stock at 175. This trade is done for a debit. It's done, though, for $1.05. Now, that's it. That's the risk. What's the maximum risk in the trade? $1.05. What's the most you can possibly make? Well, if you have the right to buy the stock at 172.50, but somebody else has the right to take stock from you at 175, what's the most you can possibly make? $2.50. And you paid $1.05 up front. Now think about that. You're like, I don't know if I like this. I can only make a possibility of $2.50. Yeah, but your risk is $1.05. If the stock goes to zero, you're going to lose $1. You're like, yeah, but the earlier strategy, and again, this is so alluring. The earlier strategy, I only had like 30 cents at risk. Yes, but the earlier strategy had no probability of being able to make money. The probability in this trade is tremendous because all you need in the next 16 days is for that stock to oscillate higher, even if it ends up going lower, and you could be profitable. The probability of the stock going up, back down is huge, and I cannot stress this enough, okay? Some people like spreads, some people don't. By the way, I'll make you something clear. You have the right to buy the stock at 172.50. Somebody else has the right to take stock from you at 175, but do you ever have to own the stock? No! You don't have to own the stock. You never had anything to do with the stock. You don't want to own the stock. This is about strategy right now. I don't want you to worry about all the nuts and bolts and what about expiration? What about this? We're going to come to that. What I want to get to, okay, is the logic. Why did we go out? All right. Earlier, I showed you a strategy where you only had 30 some odd cents at risk. Now I'm showing you a strategy. You have $1 at risk. You have at risk what you want to have at risk. But this trade that I've constructed has an infinitely higher probability of making large percentage returns. Okay. Conversely, you're limited in what you can make. And that's the one trade-off, like when I talked about a moment ago, like exploiting flaws. People put on strategies where they're constantly swinging for the fences. Okay? You know, if you can swing for the fences, all right, sooner or later, that bat's going to whip around and hit you. You go out there and you know what your risk is for $1. Now, take a look at this, okay? Literally. All right, literally the very next day. And again, this is 175. All I did, all right, was sold the trade today. And here's the order to sell it. It's a $2.20 credit. Now I'm going to recap the entire thing here momentarily. All right, anything I bought, I sold. Anything I sell, I buy. I originally, and again, I'm just going to recap it. You saw the stock now move to 177. So initially, we had a stock trading at 172. Okay. Ultimately, what? Just about a week and a half later, right? It jumps to what? January 16th over here. Now we're trading at 177. The stock moves $5. What do we make? Here's recapping a little bit about the Apple spread. Well, we went out and we purchased the trade, okay, for a $1.05 debit. We turned around the closing trade and we captured $2.20 credit. And if you look at this, you're like, well, what did you make? Remember, the maximum that a spread like this could be worth is $2.50. I didn't make $2.50. All right, I made $2.20, of which I already paid $1.05 up front for it. So if you're like, running the math, you're like, you take the $2.20, subtract the fact that you paid $1.05 for it. What do you come out to? It's $1.15. Again, run it. Make sure that you get it. I went out again. I bought this thing for $1.05 and sold it for $2.20. It's $2.20 minus, of course, the $1.05, right? I made $1.15. I made $1.15 though off of $1.05, which is the equivalency of 110% return on the investment. And that is the effective way to step into something that you believe, for example, is going to go up or you believe is going to go down. The most important thing, though, it wasn't the directional bias. It's choosing, the correct strategy, and it's hitting 110% returns. But you have to realize, see that $1.05 debit? You got to realize something about the $1.05 debit, all right? The right trading strategy and the logic. This is a spread trade. As I said, the $1.05 debit, it defines your risk, provides an incredibly high probability of success. And some people say, well, why is it such a high probability of success, right? And let me back up for a second and deviate to that. You had a stock that was initially only trading at 172, okay? You only needed the stock to get to 175. Again, 175 to maximize the return on the investment. So here's an underlying that if you think about something like an Apple, okay, here's an underlying that oscillates, a couple of bucks every single day, and it was trading at 172. And you have such a high probability that at some point, let's say that in the next week or two, that it's going to hit 175. That's the thing people don't realize. I'm not trying to hit it out of the park over here. I'm just looking for like a $2, $3 move, get out, make 110%, return on there, duck, dive, weave. You don't want to get, all right, involved in heavy amounts of risk. You want to go out there, define your risk, high probability of success, and the high probability of success is specifically what I showed you. The probability of a stock moving up or down a couple of dollars in a few days is easy. You're limiting all the capital exposure. Doesn't need a stop order. Who needs a stinking stop order when you have $1.05 at risk? You never need to buy or sell the stock. All of the attributes of this. You could do this in an IRA too. If you want to be tax deferred, great. It's the right trading strategy, the right logic. Now, again, tonight, it's all about creating trades that work. And by the way, we're not done. We're not even close to it. All I wanted to do was pick apart, if you will, one flaw. Now, how many people, let me ask this question. How many people have gone into spread trading before even tonight? Before you've even seen this tonight, how many people okay, I've already done spread trades? Anybody? Because we're going to go beyond this. Again, I just wanted to give, and exploit one area. So a couple of people in there, done spreads, do it a lot. Debit and credit, sweet. All right. Creating trades that work. First and foremost, I'm going to make the argument that most clientele, all right, are right picking direction. However, they just do not know the correct strategies and criteria to employ to make money. This is actually going to be a key factor as we go along tonight. All right, the correct strategies and the criteria. You ever feel like you're stepping up to the plate in any given trade? You're stepping up to the plate and you're kind of like, this is the strategy I use. And I'm like, what do you mean this is the strategy? Well, this is the strategy I use. And I'm like, wait, but you can't be a one-trick pony in options. You just can't be a one-trick pony. All right? Criteria coupled with the correct trading strategies is where you got to go. So before I go any more detailed into strategies, I want to present to you a couple of really TheoTrade principles. It's how we approach the market. And listen, if there's one thing you want to get down tonight, right? Strategy, you're going to learn that strategies in the markets, that's only 10% of the battle. I cannot stress this enough. Strategy is only 10% of the battle. You got to have the right approach. You got to know what strategy to use when. Do you ever feel like that? Like options, it's kind of like a toolkit. And this is not complicated stuff. It's a toolkit. You don't have to have like 50 different strategies. Everybody's like, there's 50 strategies. Well, the irony of that is there's really only two core strategies. But before I go any more detailed into that, I want to give you the approach to the markets. And when I say the approach to markets, here are some following principles. Then we're going to jump back into strategies because this is going to make a lot more sense. The TheoTrade principles. And I always say, obey the rules. Okay? Trade logic, capital allocation, directional bias. These are kind of like, when we were like building TheoTrade, like every company like has some mantra over here. I guess this one's ours. It's trade logic, capital allocation, directional bias. It's everything, okay, that if you look at the commonality in all the different instructors here at TheoTrade, whether it's Doc, whether it's Tony, whether it's Slim, whether it's myself, Corey, Jeff Bierman, everybody approaches the market this way. By the way, this isn't something that, we initially wrote. Yeah, this is stuff that people have been doing for decades. Trade logic. Let's explain it. Place, strategy, and trade logic first. What that means is the vast majority of people involved in markets, they're infatuated with market direction. Everything you're bombarded by, you turn on CNBC over there. Oh, this is where I think the stock is going to go. There's a guy throwing a chair about where a stock's going to go, right? Throw a bull, throw a bear. Guess what? Attempting to predict the next move a stock's going to make, that can be futility. I'll give you one right now. Right now, the market, it's moving up, and yet people still can't make money even though they could see it moving up. In reality, what you think a stock is going to do doesn't always translate to profits. You just saw that. Many investors and traders alike, okay, place far too much emphasis on being right. The strategy, the right strategy coupled with established entry and exit criteria allows you to not necessarily be right in picking direction in a stock in the markets in order to be profitable. I can't stress that enough. Meaning like, you know what? What is trade logic? What trade logic really is, it's strategy coupled with a little bit of math, okay? And what it means ultimately is that trade logic, that strategy is paramount. That comes first. Employ the wrong strategy, it doesn't matter if you're going to be right. That's my only point on this slide. Employ, okay, the wrong strategy, and you've got no mathematical chance of being able to make money. And anybody in this business that has been around, okay, for years and years knows just that. How many of you guys have actually done stuff like this and you figured out on your own? You're like, yeah, the strategy totally matters, okay? But you're going to find out in a moment, strategy alone isn't enough. You got to have entry and exit criteria. Now, next on there, capital allocation. Now, capital allocation, people have like disbelief when I bring this up, but how and where you allocate capital should strongly be considered as a viable portion of your trading methodology. Capital allocation actually takes precedence over being right. Why? Because, check this out, experience in watching order flow for decades has taught us invaluable lessons. You ever been stopped out of a trade or bailed out of a position only to see the markets turn around shortly thereafter? Now think about that for a second. Okay? Think about just that for a second. You've been stopped out of a trade or bailed out, and like the second you bail out, That's when the market actually bottoms and turns around. All right, how many people have ever been through this one? Again, even if you're watching this, you're watching a recording, you're like, amen. All right, that's something that just hammers people day in and day out. And that, to me, is one of the things that I have to tell you. You're watching like order flow for 15 years like I did, it frustrates you to no end. It's like this horrible, horrible movie that you can't turn off, and you just see it playing out. You're like, oh no, don't go in there. Don't go in there. And literally the market bottoms out. Everybody's bailing out of positions left and right. You're like, there's the bottom. Okay, you can tell when the bottom's in. But how and where you allocate capital can define not only losses, but it can actually be the defining factor. That's right. Capital allocation can be the defining factor in your overall success or failure in the markets. Our war cry has always been duration over direction. All that means is you got to be capable of sustaining trades long enough. It doesn't mean that all your trades are going to be profitable. But if you can't sustain something, that means hold. If you can't hold, it's like, hold the line, hold the line. You got to be able to survive long enough to be right. And you know what? It's easy to survive when you had, like in that Apple trade, what do we have at risk? $1.05. We only had $1.05 debit at risk, right? You got to be able to survive long enough to be right. Think about that, all right? Now, all three of these are making sense, right? You're talking about trade logic, you're talking about capital allocation. Last, but definitely not least, is directional bias. We're not anti-charts, okay? I am not an anti-chartite. I have been called worse, but I'm not an anti-chartist. The fact of the matter is, okay, as I said, markets are infatuated. Do you realize that people spend, okay, tens of millions of dollars a year on the latest, greatest charting study? The latest, greatest charting study. Do you realize, okay, this is a chart. There's almost 400 studies built into this trading application. I don't care if you're on this application or not. There's thousands of studies that you could code into here. And every single one of those studies is based on the same crappy data that the previous study is based on. All you have is volume and price. Oh, you also have time. Oh, I didn't know about that one. You think about that for a second. Look at any charting package. I'll go nuts about this. You know why? I was there. We built this thing. Okay? Jeff Bierman specifically was one of the people that helped build the entire charting application, okay, on this platform. Every one of these indicators that guy knows. It's crazy. And every single one of them, like this is a forward-looking indicator. It's a forward-looking indicator that looks at past stock price movement. The only thing that a charting application can see, somebody's like, but look, it can see price and it can see volume. Maybe a little earnings out there. Think about it for a second. There's 400 different ways to twist that out there. But that's why directional bias, not anti-charts. You just got to recognize where you think a stock's going to go. It doesn't always translate. And the market doesn't always agree with your sentiment. I'm so bullish, I'm so bearish. Yeah, and the market goes, no. Being right directionally can't define you. It can't define you as an investor or a trader. You may not be right often enough. At TheoTrade, let's got to understand, we're realists, right? Everybody's going to give you follow the bouncing ball. 3 hours up, it's definitely a buy. It's all garbage. You got to understand, if you've been in this business long enough, you will. Place capital at risk only with the correct trade logic and a comfortable allocation. Directional bias is absolutely part of getting into the market. It's absolutely part of strategizing about the market. But if it's the defining factor, you're dead. And you have to realize that in this business. And I hammer that. Now, let's move forward. Are we having fun yet? I told you I'm going to go a little nuts tonight, a little off the rails, because this is the stuff that I get kind of passionate about. Because people, again, I watched for 15 years that people get in the same crappy positions again and again and again and again. And it's like this bad movie. And you're just like, stop. No, don't go in there. And you just see them get hammered day in and day out. And then you know what? Then you get a new crop of traders 5 years later and you're like, oh, here we go again. Then we hit 2008. I'm like, okay, all bets are off now. It's chaos. This is strategies that you need in your arsenal, okay? Thus far, we reviewed one strategy, okay? And our TheoTrade principles. That's it. That's all we did thus far. And it related how we approach the markets. But what other strategies do you need in your trading arsenal, right? let us review a few of the core strategies that we all need. All right, that is not, okay, this is not a rhetorical question. What strategies do you honestly need inside of your trading arsenal? And this is going to get a little bit complicated. So again, if you're brand new to trading, as I said, big concept. So you guys tell me, what do you need? What do you need strategy wise? Huh? Anybody? So as somebody just said, verticals and calendars. Amen to that one. Those are the two primary strategies. That's what we're going to start doing right now. We're going to dig in. What are we looking at here? Well, this is a curve. This is a curve. And all I'm going to do is I'm going to take you through, as I said, big strokes of logic. Now, I'm going to remind you, strategy is imperative. And you got to understand like what a spread is. You got to understand what a calendar spread is. But what will actually make you money in markets isn't strategy. It is strategy coupled with entry and exit criteria. And what entry and exit criteria means, that says like, step, all right? Apparently I can't write on there. Step 1, right? Step 2. It's literally like, do you do this for your own trading? Do you have steps? Like, and I'm serious about that. Do you actually lay out different steps for everything that you do in the market? When I say step 1, all right? Me, for step 1, liquidity. All right, I don't want to write it out. Step 2 usually is time frame. That's a big one, okay? Step 3 in here, and we go on, and we start like running through what would step 3 be? A lot of the time, okay? A lot of the time. So liquidity comes first, time frame comes second. Bias. Bias is a step. It doesn't necessarily mean that that's the core logic of the trade, but when I say bias, are you bullish or are you bearish? Step 4. Okay, step 4 of any given strategy out there, what would I go into? Okay, that is going to be what we call, in terms of options, strike selection. All right, step 5 over there, and we just go and go and go. I have a question. Do you do that for every single strategy that you employ? Do you have a checklist out there? I mean, because you got to have something to go off of, something pre-flight. Now, let me go into one of the core strategies. So here we have a stock, and the stock is trading right at 100. By the way, this could be any stock. It doesn't matter what it is. It could be, it could be Boeing, all right? Although Boeing is like, $380 stock, and then it dove down. I'm just kidding. Anyway, if you look at this, it's a $100 product. Now, that $100 product, and the reason I use this distribution curve, the $100 product can go higher or the $100 product can go lower. Let's say the stock could go up to 110 or the stock could go down to 90. Right? And we'll give an equal proportion to that. Now, what kind of option strategies can you build over here? One of the answers that you got to learn is things like selling spreads. We can come out here, for example, and we can sell a 105 call. We'll turn around and simultaneously buy a 110 call. Now, if you're confused by this, you're like, wait, what'd you just do? I sold a 105 call. Why? I don't know, because I wanted to collect some money. How can you sell something you never owned? Well, I'm selling myself into an obligation. I can sell the 105 call. Let's say on the 105 call, I collect $2. That's not bad, all right? I collect $2. Then I have to buy this one. Then I got to pay out 50 cents. So in one trade, I'm going to collect $2. In the other trade, okay, I'm going to pay out 50 cents. I'm in that thing for what's called $1.50, but this is a credit. It's a credit. That, people, is a credit spread. It is a credit spread. Essential that we understand it. Okay, a little hard to read over here. I get it, but we're selling a 105 call. Why are we selling a 105 call? First of all, selling a 105 call obligates me to give somebody stock at 105. But I have the right to buy the stock at 110. But if the stock right now is trading at 100, do I own the stock? No, I never had anything to do with the stock. I never want to own the stock. I don't have to. It ties up too much capital. The stock's at 100. Where can the stock go? Well, it can go down. It could stay flat, or it even could go up. But if it goes up, I just need that sucker below, anything below 105, and I'm golden. And I keep my $1.50 credit. Now that sounds easy enough. Okay, and that's a credit spread. And again, this is the kind of stuff that, this happens to be what? It's a bearish trade. I want the stock to stay flat or to go down. But even if it does go up, you got to understand there's three things that can happen in the market. The market can go up, the market stay flat, or the market can go down. Here, I've actually got encompassed all three. This is a fairly high probability strategy. Just stay below 105. But lately, that's not what you want to do. Okay? And really, the question with a strategy like this, what do you do when it goes against you? What is the right option to sell? Like, should I sell the 105s? How come I'm not selling further? Okay? It depends. That's what criteria is about. That's what I remember a moment ago I was just saying. All right? What's the steps? Step 1, liquidity. Is this stock liquid enough? Step 2, time frame. How far out do you actually sell these options? Do you a month? Do you do 2 months? Maybe you just do 1 week. Right? Continuing on with this one, then you got to select the strikes. You know what strikes are? Why did I use the 105, 110? Why? By the way, the next thing is here, my bias. Why did I sell call spreads? Why not put spreads? I could have sold puts. You're like, well, what's a put? Okay. Well, hey, listen, this is a bearish strategy. There's also a bullish strategy. I could have done that as well. And you got to think about all of those variables. And there's a lot of variables. I mean, take a look at an option chain lately. Seriously, take a look at an option chain on Apple. Look, there's 3-day options and 10-day options and 17 and 24 and 31 and 38, set, hut, hike. I mean, look how many different weeklies there are. It's insane, right? And then you open up these option chains and you open up all strikes. You'd be scrolling through this for hours, okay? There are a lot of options, people, on dem dare options. That's the kind of stuff that we talk about in criteria. So you can go out there and you could sell a spread. Selling a spread is an essential strategy. And again, tonight I'm just trying to give you a little bit of a flavor. But maybe you didn't want to be bullish. Maybe, okay, all right, or bearish. Maybe you wanted to be a little bit bullish. I could have gone out there and I could sell the 95 put, turn around and buy the 90 put. What is the 95 put? Well, I'm selling the 95 put. That gives somebody the right to sell stock to me at 95, but I'm buying the 90 put. Why? What happens if the stock goes from 100 and crashes? It GEs you all the way to 80. GE, it's been bad lately. It's like the only thing that's been down this year. It's the only example I have of a stock going down. Well, the most you can possibly lose in this strategy, it's a $5 wide spread. So it limits your losses to $5, of which, let's say that you collected a credit up front. Remember, this is a credit spread. Credit of $1.50. So you collected $1.50 up front, but you lost $5. What'd you actually lose? $3.50. Is that the right probability for you? That's something you have to decide. Okay? And to continue on, again, we having fun over here? Because it's getting interesting. Right? To kind of continue on with this. Then we look at a strategy, and people tend to forget about this. Here's a stock trading right at 100. You know, you can do what's called an iron condor. People have forgotten about an iron condor, but I'll tell you what. Just about a week ago, clients, all right, started emailing me. They're like, hey, are you using the iron condor much? I said, yeah, I do use it periodically. Okay, but it's all about the time frame. What is an iron condor? For those of you that have absolutely no idea what an iron condor is, here's a stock trading at 100. We're going to go out. Okay, and we're going to sell. And by the way, let's even have more fun with this. Let's say it's not even a $100 stock anymore. Let's get crazy. Okay, now let's make it a bigger stock. Let's say that this is something like the spiders. Okay, and the spiders lately, I mean, and again, if you're unfamiliar with the spiders, and the spiders happens to be one of the most prolific products out there, right? It's trading at about 275, 276. It's the only reason I'm bringing it up. Let's say it's the spiders. Okay, let's just change the product up over here. Let's make it much more real, if you will. Now I'm going to round it. I'm just going to say the SPY is trading at, let's say, 270. We can go out there and we can sell, okay, in this case, the 280 calls, turn around and buy the 285 call. Simultaneously, we're going to go about $10 out of the money. We're going to make this equidistant. I'm going to go out there and I'm going to sell the 260 put Then I'm going to turn around and buy, okay, the 255 put. This is an iron. What does an iron do? Well, when you sell the 260, 255 put spread and simultaneously sell the 280, 285 spread, what do you want to have happen? I need us to stay right smack in the middle. I mean, this is like the most schizophrenic strategy ever, right? The market goes up, you're like, oh my gosh, go down. And the market goes back down, you're like, okay, I'm cool. I'm cool. There's the market. Then the market continues down. You're like, oh my gosh, go up. And then it goes back up over here. As I've always called the Iron Condor the most schizophrenic. It's like an unnatural strategy, right? Because you're actually trapped in this box of what's called neutrality, where you like, don't go up, don't go down. But I'm going to tell you something about the Iron Condor. It is now becoming much more in play. It hasn't been. Okay, we're transitioning in the markets. The Iron Condor, it is so very, very back. But this Iron Condor, I'm telling you, it's all about time frame. The question is, which options, how far out in time do you sell? Now, that might look complicated to you, I'm telling you. Okay, this takes such a small amount of time to learn, but you've got to understand that this, like an Iron Condor, needs to be in that basket. Needs to be in your basket of strategies over there. And I'll tell you what, I'm also going to show you how to defend the Iron Condor here momentarily. Because what happens if the market sells off fast? Okay? But again, this is huge. There are ways now, once again, to make money in the Iron Condor. And that hasn't been, okay, relatively true. It's been a long time since irons have been back in play. Last but definitely not least, I'm going to throw one more strategy at you tonight. And something that I absolutely believe that everybody has to have in their arsenal. And you know what? I'll do this one also in the spiders. I look at the markets day in and day out. You know what? Let's not even do this. Let's not even do this over here. Let's do it. We're going live. I look at markets day in and day out. This is a 9-month chart. Okay? Listen, I don't care what time frame here. Let's just bring up a 3-year weekly. Okay? The market has been going up. Is that fair? The market has been going up. And what does it do? It continues to go up. How high does it go up? I don't know. It just goes up. Well, one of these days, we're going to open into a very severe market condition. A very severe market condition. And that is where strategies like ratio spreads come into play. Now, some of you guys know ratio spreads, some of you don't. And listen, based on time tonight, I've already eaten an hour. I got to get through this. So guess what? I'm just going to throw a ratio spread onto the screen, and I'm going to let you guys look at it. But here's a strategy that, again, and I'm going to throw delta up there just so I can actually see it myself. But I'm going to throw a strategy at you that I think is absolutely essential for survival in today's marketplace. This, people, okay, is what we call a risk twist trade, all right? And what a risk twist amounts to is it's just a series of I'm selling 1, I'm buying 3, and I'm selling 1. And yeah, you can see I'm doing it all the way out in April, but I want you to look for a moment at the risk graph, okay? This is where the market currently is. So that's where the market currently is. What does the strategy do? If the market starts to implode, the strategy takes off to the upside. Do you realize, hey, look, this is one contract. That's one contract. 1 by 3 by 1. That if the market starts to tank, and this is not huge, but if the market starts to tank, this thing's up $500, it's up $1,000, and that doesn't even include if the volatility starts to go up, that the VIX starts to go up, this thing makes even more money. You know what the interesting part of this strategy is? Okay, this strategy, you know, we were just looking at this a second ago, and we're looking at the idea like this Iron Condor, right? And the Iron Condor needs the market boxed in. Well, guess what? How about we have a strategy out here that cuts the risk? It cuts the risk. If the market starts to sell off, we'll actually cut the risk. That is, in fact, what this can be done. Now you actually have, all right, two strategies combining to one another. And that's, I mean, listen, all I wanted to do tonight is give you a flavor of The right trade logic. What's the right trade logic? It's looking at trade logic first. It's knowing the strategy. Then it's looking at capital allocation. Then it looks at directional bias. But you didn't see me in any of those strategies that I just created. You didn't see me once to have to discuss bias. Okay? I threw it up there on the screen, glossed over it. Why? Because there's things that you can do in this business that are not about market bias. But the secret, it's in the sauce. Now everybody thinks to themselves, I can read about option strategies anywhere, and you can do this. By the way, you can. You can Google all the different option strategies. But think again. This is only 10% of the battle. Strategy really is only 10% of the battle. At TheoTrade, we do best is criteria. That's what I've been talking about all night. We give you the specifics, the steps behind different trading strategies. If it's an iron condor, what is criteria? It's a recipe. If it's a vertical spread, what is it? It's a recipe. Okay? If we do a butterfly, what do you got? You have a recipe to be able to get into that butterfly. If it's, earlier, a moment ago, I showed you this crazy strategy. By the way, I share this with anything. Okay? This thing cost you $1.40. How about having $140? Because if you do one contract, it's $140 at risk. You have $140 at risk. But if the market tanks, this thing just keeps going and going. All right? It has unlimited profit potential. Well, not really unlimited because the market can only go to zero. Nevertheless, you get the point. This thing has incredible profit potential for minimal upfront risk. That's right now. If you think the markets are going to tank, that's how you got to play the downside. But you got to have the right recipe, the right strategy. And that's what criteria is. Criteria answers the trading specifics, the trading recipe. What might be a good stock or ETF candidate for you to trade? I was talking about liquidity earlier, but hey, what's a good candidate? What's the correct options expiration cycle for a spread? How much capital do I commit to this iron condor? We just talked about an iron condor. In an iron condor, and we're just jumping around from strategy. What strike price options do I sell? What strike options do I buy? That's what we do here at TheoTrade. We create recipes and trading. That's what we do. Okay? We answer all the trading questions. What's the right probability for your trade? How many iron condor contracts do I need for the account size? I love this. When do I close my risk twist spread? What I just showed you a moment ago, this is known as a risk twist. And with the risk twist, the reason it's called a risk twist, okay, it's actually twisting what's termed skew in your favor. This is twisting market what's termed skew in your favor. For those of you that are a little bit more advanced, that'll mean something. Okay? What if the stock sells off big? Do I bail out of the short spread? What if the stock in short spread is something we just talked about? Credit spreads, right? What if the stock, rallies massively? Can I fix a losing trade? We've got the answers to all the trade-related questions. All right? That's, again, what we do. We build recipes. They've got definitive criteria and checklists. Each strategy and each unique variable that you're going to encounter. I mean, what can the stock do? It can go up and go down, right? It could stay flat. But what other variables? You hit expiration. Options, they got a lot of variables. You got a lot of choices in options. How, when, why, at what price? Earnings are approaching. What steps do I need to take? Can I sell options without ever owning the stock? Of course you can. Can I do this in an IRA? Anything that we teach, you could do in an IRA. You can do anything in the IRA. It's just the beginning of some of the variables that you're going to face while trading options. Now, how would you like to spend a full week with TheoTrade, detailing trade logic, setups, and criteria for all the major option strategies? We have never done anything like this. We're actually going to do what's called Strategy Week. Do you get to spend a week with us? You're like, I work for a living. I get it. But we're going to talk about selling spreads, iron condors, covered calls, and selling puts. Everybody knows about that. Calendar spreads and roll values. Then on the last day, advanced strategies, ratios, risk twist spreads, and more. This is Strategy Week, using high probability option strategies. I will be the instructor. It is coming up. And when is it coming up? It's next week. And this is the only presentation we're doing for it. It's next week. Now, the actual strategy day itself, it will take place between 10 a.m. to 11:30 a.m. Eastern Time. Now, we broadcast all day long. All right, we broadcast throughout the course of the day, but the strategy week, we're going to limit it to chunks of 90 minutes. However, there are 5 90-minute segments. Everything we're going to do, everybody's like, oh, wait, is it going to be recorded? Yes, you have lifetime access to on-demand recordings. Those on-demand recordings are available immediately following each daily session. You can also download the class slide decks, and there are decks. When I say decks, hey, listen, there's 5 of these things, including entry and exit criteria. So what we're doing is we're compiling all the different option strategies that you need into one, okay, kind of condensed super strategy week. In addition to it, by the way, the whole thing is $199. We're not even close to done. Go to TheoTrade.com/week. I'm telling you, we are not even close to done. Hang on a minute, because there's so much that we're going to pack into this week. Clearly, all right, it's like that would be overwhelming. Yes, and some of you cannot take off 5 days. But you know what? Maybe you can tune into 1 or 2 of them live. The rest of them, do it on demand, right? I mean, people tell me all the time, they're like, hey, you know what I did? I will forego Netflix for 1 month. Seriously. Get rid of Netflix for 1 month and Amazon Prime Video and Hulu and Vudu and everything else out there. Get rid of them for 1 month. Why don't you binge watch some of these sessions? Okay? In addition to this, and again, the entire week is $199, but it's literally, you're going, okay, to 5 independent classes, which I'll show you here in just a moment. In addition to it, we're also giving you Options 101, the basics and beyond. It's to get you ramped up for it, okay? Options 201, Vertical and Calendar Essentials. Those are the primary building blocks behind what we're going to talk about. But you know what? In Options 101 and Options 201, we're just teaching you the building blocks. When you come to Strategy Week, we're going to be talking about criteria. We're going to talk about entry and exit checklists. Number 3 bonus on here, Options 301s, the Volatility Essentials. This, listen, I know some of you guys have experience because everybody's like, I have experience. Good, right? This is the stuff, though, that you don't know. It's the Volatility Essentials. Everybody should watch that. And I know a lot of people tune into this and they're like, okay, this is about the point that I tune out. It's $199. I don't care how experienced you are or how inexperienced you are. Everybody, to get you on the playing field for a market that's in transition, you need to check this out. You are going to absolutely love what we're going to do. Before I go on, in addition to the week, we're also going to give you a 1-month access pass to TheoTrade. Okay? That alone, okay, is well beyond the value of $199. Okay? What is a 1-month access pass? I'm going to talk about it here momentarily. Okay? That it's really what I think one of the most compelling things that we do, because it allows you to access archives of coaching sessions that we've done, okay, in excess now of 2 years of archives. If you name a topic, it is in there. All of it is available. And it's not just myself. It's Doc Severson. It's Jeff Bierman. It's Slim. Okay? It just goes on and on and on from Tony Rago. Listen, anybody from any walk of life, if you trade, you will want to check this out. All right? You will in no way, shape, or form. First of all, you will be overwhelmed. Is that okay? Are you going to pay $199? Would you rather be overwhelmed or underwhelmed? All right? I think everybody should be overwhelmed. And I want you to think that for $199, that you're not only going to get your money's worth, you're going to get blown away by what we do. Because there's a lot of education out there. There's a lot of crap out there. There is nothing to the likes of what we're going to do in Strategy Week. And there's definitely nothing even close to what we do on the 1-month access pass. It allows you to view everything that we do live and everything that we do in the archive of our coaching sessions. Again, I'll describe that in a moment. What we're doing during the week. And by the way, I will throw up here the address again, and I will show you that page in a moment. Okay. Again, it's TheoTrade.com/week. I'll also throw up our email address in a moment. I will throw in there as well, okay, our support at TheoTrade. That's the email address. I'll throw our number up there again. So it's TheoTrade.com/week. This is the way that we're going to lay it out. Selling vertical spreads. why entry and exit criteria is the key to consistent returns, so you're never left guessing which options to trade. A lot more than that. Day one, we're going to talk about the buying and selling of vertical spreads. Day number 2, iron condors. Iron condors, it needs a day. It needs 90 minutes. Okay, 90 minutes step by step, how to enter these high probability irons. Nothing's going to be left to the imagination, that one. We're also going to define the time frame. That is easily worth the $199. Then, come Wednesday, covered calls and short puts. You're going to find vital criteria for selling the right options. Again, eliminate some of the guesswork out there. Get time decay on your side. Then we talk about calendar spreads and rolling trades. Now, that may not sound like a lot. Calendar spreads is important. Rolling trades is essential. If you can't do it, you don't survive in trading. Period. If you cannot roll option trades, you die. Why? Because rolling works for covered calls. Rolling works for iron condors. Rolling is needed in selling vertical spreads. It's a core piece of logic amongst all the strategies. You're going to learn how to create calendar spreads, volatility bombs, while taking a comprehensive approach to pricing and how and when to roll trades. Okay? The last day, we're going to talk about advanced strategies, ratio spreads, risk twists, combining option positions. I'm really going to focus a lot on risk twists on that Friday, right? Answer some questions over there. It's going to be a party. We're going to talk about which stocks and indices make up the best candidates, which strikes, what expiration, all the criteria, when to open, when the best time to close this stuff. And again, all of this has a lifetime access to the on-demand recording. That is TheoTrade.com/week. It's the first time we've ever done anything like this. It's strategy week. In addition to this, you get a TheoTrade 1-month pass. Okay? Listen, it's just a month. But it's a month that you can dedicate, all right, to spending some time. Spend a little bit of time every single day on the weekends, a little extra time. But this thing is huge. Everything, okay, that we're going to do online for the next month. Daily coaching sessions. We do approximately 5 hours a day. And again, I'm going to bring it up right now, right here, in here, so you can see everything that we do. And again, this address is TheoTrade.com/week. Just click add to cart. We're also here to answer questions. So if you got a question, you can fire it away in there. But I want to show you what the 1-month pass is, because I feel pretty strongly about it. And then I promise we will talk, all right, about we're going to talk about a number of questions that have come up. By the way, somebody says, did you include the probability calculator spreadsheet? Janice, sure. You can email me for that anytime. By the way, the 1-month pass starts when you enroll for this. So you can literally, tonight, you're in, you're on. By the way, everything that happens for the next month, you get access to. When I say everything that happens in the next month, what does that even mean? What's coming in the next month? Well, you know what? We have strategy week, but I'm going to clue you into a little thing. We also have other classes coming up inside of the next month. You will be astounded, again, at what we do inside of a given month. And I told you, you're going to be overwhelmed. Good. We're going to do daily coaching sessions. As I said, we broadcast right now about 5 hours, per day. Do you have to watch all 5 hours? No. You know what? 3 of those hours is just us doing live trades. Intraday, like 3 of the hours. 2 of the hours, though, are coaching sessions. That stuff, if it interests you, you should listen to. There's a live trading room, okay? In the live trading room, I'm going to show it to you. Everybody's giving you real market insights throughout the course of the day. All right, and by the way, if you have the time to log in there when the markets are open, great. I think you'll really enjoy a lot of the people that are in that room on a day-to-day basis. It's a wonderful group. On a day-to-day basis, okay, there's just under about 1,000 people through the chat room each day. The instructor and coaching archives are available to you. This is part of the 1-month pass, right? So instructor and coaching archives. If you miss something, okay, from any of the days, going back over 2 years, you just pull up the file, okay? Start here selection. What is that? What is a start here? You know what? You're going to get to our site. And let me show you actually what the site looks like. You're going to get to the site and you're going to be like, whoa, All right, what does the archives look like? Well, here, for example, is the coaching archive. And I want to show you what it looks like because you better know, hey, you're going to pay $199. You want to know what you're paying for? Okay, for example, it's broken down to month. So let's go back. Let's go back in time to November of 2016. Oh, I remember it well. Coaching sessions, synthetic options demystified. Trading low volatility markets, evaluating option strikes, implied versus historical expected moves, buying and selling verticals, complex reversal indicators. Oh my, this is just like what? That's 1 month. Okay, that's 1 month. But as I said, it's overwhelming. You know what? That's why there's a button that says Start Here. You know what Start Here gives you access to? Options 101, 201, 301, okay? But also courses like order execution. That order execution alone, I think you'll find it worth $199. Nobody understands this stuff. It's a 3-part series. Crash Course in Option Geeks. What products to watch and why. You want to know what to trade? What products to watch and why. That's in the Start Here. Like if you want to, tonight, start streaming this stuff tonight. That's, fair enough. By the way, if you don't, you're like, I don't even know what to look for. I don't know. Type something in. Probability. Hit enter. Okay. And it'll pull up everything. Take high trades and, on and on and on. Coaching session. The high probability intraday trading system. All right. Or you want to do something with vertical spreads. Okay. Here. There's vertical spread. Enter. Let's pull up everything on vertical spreads. I just want to show you that the entire archive is searchable. Why we use vertical spreads. Using expected move, vertical spread. On and on. Okay. That's some of the features that we have in there. What's the chat room look like? Well, if you want to see the chat room over here, apologize, we're going to come right to it. Want to go to the chat room? This is what it looks like. We broadcast right here, okay, and everybody can chat in. That's what we're doing, for 5-6 hours a day. In addition to it, okay, if you need indicators or scans, they're all in there. It's included. All of the indicators that we use on a day-to-day basis. A lot of people, they have proprietary indicators over here. You go to the charts and you like this Quantix, okay, or this TheoTrade RSI. We will give you all of those. They're already there. They're in, okay, and downloadable right now. You just come over here to the chat room, cruise up here, and you're like, oh, shared charts, scans, and studies, and we'll give you links to all of that. Again, there's a lot of firms that'll charge you $1,000 just for an indicator. It's all here, right? That's what we do. Last but not least, we do email out trades, okay? You have access to everything that you're ever going to want in there. It's $199. You're not going to go wrong. On top of it, right? Sign up tonight for it. It will qualify you. If you have an account at TD Ameritrade, it will qualify you for a discounted options rate. I cannot and will not discuss that options rate live on this session. You can chat in and we can help you. All right. We can help you with that if you have a question about the commissions. By the way, you do not have to open. You do not have to open an account with TD Ameritrade. If you have an existing account, okay, you can do that. If you would like to open an account, we will, in fact, give you a link to do so, and it will qualify you for the discounted rate out there. By the way, do not call TD Ameritrade asking them for the discount. We have a specific numerical code that we use for those discounts over there. So anyway, if you want, chat in there for the questions. All right, let's get to a couple of questions. Again, the whole thing, it's $199. It includes not only strategy week, but includes 1 month, access to TheoTrade. And again, you will be completely blown away by what we do. This is theotrade.com/week. Right here, it's 800-256-8876. Also support at theotrade.com. I just wanted to make sure everybody saw that. Now, let's get to it. Let's answer a couple of questions in here that frequently show up. Okay. Oh, somebody said, I'm a complete newbie. All right. Will this course be helpful? Absolutely. So Val, it's not only going to be helpful for a complete newbie over there. It's designed for that. That's why we have options 101, options 201, and options 301. But I do suggest that you go through some of the prereq, if you will, before next Monday if you have time to do so. By the way, Charles, yeah, the discounted rate at TD Ameritrade, it is awesome. It is awesome, and it is. By the way, somebody said, is this different than the credit spread class? Oh, yeah. Oh, yeah. So we're going to cover a little bit about credit spreads on Monday, but then we're going to go right to iron condors. I mean, you got to realize we've done classes here at TheoTrade on iron condors. We've done classes on risk twist spreads. We have done classes, okay, on, credit and debit spreads. Well, guess what? We're going to spend an entire week and just blow you away with everything back to back. Because again, right now, there are incredible opportunities in this marketplace. Just huge. But you got to have a couple of things in the toolkit over there. I'm not asking you to spend, years learning this. I'm asking you to spend a week and know some of the core logic and the core strategies. All right. So, for one of the first questions that came in, I can't make it live. Well, if you can't make it live, Jonathan, everything is recorded. I mean, everything is recorded. By the way, we post the recordings instantaneously. All right. Like literally, you could even rewind as we're talking in there. Here's another good one. Terry said, can you help us get permission to do spreads and trade options in a Roth IRA? Absolutely. Without an equivocation, we can get you approval. However, it does depend on the brokerage firm. I cannot tell you that I can get you approval at every single brokerage firm. You have to have over $2,000 in the account. But people say, oh, I don't have experience. How am I going to get experience? Guess what? The brokerage firms will qualify us as experience in there. All right. By the way, Canadians, we have an idea for you. We have an idea because if you're Canadian, some of the brokerage firms are a little different over there. We have an idea. That one you may have to email us for. Somebody asked, David said, do you do the trades in the thinkorswim platform? I do. You don't have to, but I do. And when we do trades on thinkorswim, okay, when we do the trades on thinkorswim, and here I brought up thinkorswim again, we can do things like this. We could just copy the order and paste it right to you. We do that all the time. You don't have to have thinkorswim. Some people have interactive brokers. They got thinkorswim. All right. They got, what used to be Options House, which is now E-Trade, and on and on and on and on. Listen, everybody's got their flavor. Like, I get it. But we like to have one common theme, and that's, whatever. We like to use thinkorswim. It's because two of us worked there for a huge amount of our career. So, another question. David said, a swing trade stocks. How's this class going to help me? I think you'll love it. By the way, you swing trade stocks. Let me be clear. You swing and trade stocks, but, ultimately, the swing trading, you're never going to go out there and put yourself at as much risk, because we're going to teach you to use spreads. But in swing trading specifically, you also have access to the full week. And we have other instructors that, that's their genre of trading. I mean, that's it. Corey Rosenblum, that's his genre of trading is swing trading. He's going to be able to help you huge in there. All right. And again, I'm running a little bit late. I want to make sure that everybody is clear. All right. You've got your questions answered over here. You will be, again, blown away by what we are going to do. It's theotrade.com/week. You ever need to get a hold of us, support@theotrade.com. Okay. If you've traded in here, I'm telling you, this will take you to entirely new levels. Thanks everybody for joining us tonight. Have a wonderful evening. Bye-bye.